So first things first, let's open up your brokerage application. Let's take a look at it. I use Thinkorswim, so it's the one I'm going to cover because it's the one that I am the most acquainted with. You might use a different one. Just keep in mind, lots of these are going to be very similar. They're going to offer a lot of the same tools. They're just going to have a different UI or user interface. So your menu options might just be a little bit different. If your Thinkorswim doesn't look like mine, what you're going to want to do is go to Setup, go to Open Setup Wizard, click on Options down here. You can then customize if you want to like our dark feel, the font size, and then you're going to click Next, and it will restart your application, and you should have a layout that looks a lot like mine. You won't have the same watch list, of course, but you should have your live news and your trade flash down here. So next thing we're going to do, because this is an options course, we're going to go right into the trade tab. Monitor here. This is where all your trades are, open trades are going to appear, right? And then down here, there'll be your order book as well. You can see all the trades you've taken. If we go into the trade tab, we can see the option chain right here, right? So we're going to go ahead and open the option chain. Look at some of these. As you can see, it defaults to 6 strikes. We can change that to 10 strikes right here. Okay. And we see that it defaults to the basic option Greeks, right? So the first thing I'm going to do is I'm going to customize this. If you are a trader and like a share account, like let's say you're trading in your Roth IRA, you're probably going to want Gamma for your calculations. If you're trying to keep your portfolio at a certain level of delta, you're maybe trying to even just be neutral, Gamma is going to be important for those calculations. However, it's not going to be necessary for the course today. Theta is not going to be all that relevant either. Vega is going to have some relevance in some scenarios, so I do like to have it on there. Typically, Vega is not going to be necessary though. I'm going to add implied volatility because it's going to be important for my trading style. I'm going to add volume. Implied volatility is also going to be important for calculations that we're going to cover. And then we're going to add open interest as well. I don't really care about theta, but if you are a type of trader that doesn't want to use any spreads and you want to be swinging short-term positions, you might want theta so that you can understand the risk, although we'll also kind of cover a basic way to evaluate risk of a trade using your brokerage application. So now that we've got those set up, we can see the delta here on the option chain. We can see the Vega. Remember Vega, delta is the movement of the contract per dollar movement in the stock. Vega is going to be applied the same way, but it's going to change based off the volatility changes. Implied volatility is going to be the implied move that's built into the contracts. Remember, as an option buyer, we're betting that the market's wrong and that these can move more than expected. The volume is how many contracts have been bought today, and then the open interest is how many contracts are currently open on the market right now, right? So we can see that like today for short-term contracts, there are lots of call buyers on Apple. They had high convictions and because they were buying greater than the open interest. That's important to recognize because if you see this typically on like a more long dated contract, if the volume here was greater than the open interest, it means that people think that there's going to be buyers that come to them. Okay, it's why it's so important to have the volume here. If we were looking at a smaller stock that wasn't Apple, that was heavily traded, and there wasn't a lot of open interest here, I would be limited on how much I could bet on the stock. There'll be times, albeit they're somewhat rare, where you have really high convictions in the stock, but there's not a lot of open interest. And just a simple way to understand that is if, let's say, I'm betting on a sports game, right? And I'm like, oh, I know this guy's gonna win. No shot he loses. I'm gonna bet 100,000. And my friend says, oh, I can't bet that much. I only gonna bet 25. Would I still bet him 100,000 that I win? No, there's no real point, right? So I just match him at the 25,000. I'm not going to bet him more than that. So that's the way to think about open interest and volume is I can't take a larger position in the current open interest because then when I want to sell the position, there might not be anyone to buy those contracts from me. On something like Apple, you can typically take larger positions without much risk. And just based on the volume here, it's going to be very rare that you're in an account size where you're going to be buying more than 23,000 contracts at $250, right? And if you are, there's likely going to be greater open interest because it's probably something everyone's seen since this is such a heavily tracked stock. So let's go ahead and close our option chain and look at today's option statistics. So starting from left to right, we have our 52-week implied volatility high and then low. This can be used to show momentum, like where are we headed? Is it going relatively up or relatively down over as relative to the past 52 weeks? We have the current implied volatility percentile at 59%. It's on the higher end, right? But it's not that high. We have then at the 52-week historical volatility high and low. Again, this is just showing you momentum. And then we have the current historical volatility percentile. This is really important because what this can tell you is like, okay, are these options pricier than they have been over the past year? If this was at 100%, I'd be more inclined to sell options rather than buy options. And this is really important when people run into sell the news events. The reason that happens is because whether the outcome is good or bad, often what it does is provide clarity to the market. A volatility is textbook definition described as the percent of the swing that is expected from the market. But from the psychological perspective, it is better understood as the uncertainty of the market, right? So the news events occur because certainty has been provided, an outcome has appeared, and that outcome allows for more information. That information is then priced into the contracts, and then the volatility drops, which correlates to premiums being crushed. So when you're looking at a high historical volatility percentile, you want to be more cautious about being on the buy side, and you probably want to be more short term in your contract duration, because you're at risk of volatility being yanked out of those. Even if the stock goes into your favor, if you're in calls and the stock goes up, it can still be detrimental to your position if there's a volatility crush, because you're going to need that much more movement out of the stock to actually become profitable on your trade. And in general, when historical volatility is high, it's usually best to be on the sell side and not the buy side, especially if you're in a longer duration trade. Then we have the VWAP. VWAP is the volume weighted average price right here. This is the price that the stock has traded at the most throughout the day. All right, it's just basically an average generated throughout the day based on volume and price. For options traders, this helps gauge the average level of activity around certain prices, right? So VWAP, touches on VWAP often become built into, day traders' technical analysis. So we're hitting the VWAP. This is where I want to enter or exit a position, or, when we get a standard deviation away from the VWAP, that's when I want to make a move because it's confirmation of a follow through. Typically, I don't use VWAP. I use key levels on longer time frames, typically built off 1 hour and 15-minute charts. But if you're an intraday trader and you're in and out of positions quickly, you're doing more of a hit and run strategy, VWAP should be a very important incorporation into your technical analysis. So then we have the trade analysis, the amount of calls and puts that were purchased on the day, some statistics that go with these as well. Typically, you just want to look at the total volume to see how active the market is on the day. And the sizzle index helps provide some more clarity on that. The call sizzle index and put sizzle index, these tell you the relative amount of calls and puts against relative to the past 5 trading days, right? So we could see that 33% of calls and puts, about 33%, have been traded today. relative to the past 5 days. So today was a really light day for option trading on Apple stock. And we can also see from the put to call ratio that calls were also favored on the day for this stock. We can just easier see that just from these numbers right here, 300,000 as opposed to 200,000. So let's go ahead and close today's option statistics and go ahead and take a look at the call implied volatility and put implied volatility charts here. These charts are actually really important to understand because they can give you insights into how option traders are positioning, or even how big institutions are positioning and what their anticipation is. So it can be really hard. What we'll talk about in a moment here is just watching the flow of the option chain or watching large positioning. And, in the Discord, we're going to build some tools to watch what might be considered unusual option trading or insider trading. But if you want to know how the market is evaluating, big moves, or how it's hedging, and you want to see that a visualization of that, this is a great way to do it. So on the y-axis here, we have the percentage of the implied volatility. On the x-axis, we have the strike price. And then these lines all correlate to different expirations of the options, as you can see here. So let's go ahead and try to extrapolate some analysis off these charts. We'll go ahead and expand this so it's easier to see. The first thing that stands out to me when I look at this is the smoother lines on the put side. Right off the bat, this usually means that there's more liquidity on the put side and more demand. And we can also see what's called a volatility smile starting to form here. The more exaggerated this is as a smile, that means that the greater the expectations are for more wild changes in the stock price. So more volatility overall baked into the stock. We know from looking at today's option statistics that it is relatively higher than typical by looking at the historical volatility. So this also makes sense. It's not the most exaggerated smile I've seen either. But we can also see that on the short dated October 18th contracts, we have nearly a 700% implied volatility. Now this could mean that there's an expectation of the market crashing in the short term. And it's important to think about stuff like this because I'm recording this on October 7th, and there's a lot being priced into the market. If we looked at a VIX chart right now, VIX is persistently high, and we'll kind of talk about VIX later. And that's market trying to price in an election, an incoming hurricane, wars going on right now. There's a lot of things to be concerned about. So we can easily, though, check, like, is this actually the market betting on a crash, or is this actually just representing a very illiquid chain? If we go to the option chain, we go to the October 18th, we look at the $10 strike, we can see that there's not any volume here. There's only 10 contracts in total. I remember Apple's very popular. If it was significant, it would probably be over 10,000 contracts. So we could say, okay, the volatility in the price of these contracts is actually due to the fact that it's an illiquid chain. So this isn't really significant. What is just significant is the overall structure of this chart being a volatility smile. But even then, it's not anything that would draw major concern, other than the fact that the smoother lines here and formations here mean that there definitely is likely more demand for the put side overall as comparative to the call side. That's why it's important to look at these charts, because that's not something you would really draw a conclusion off of when you look at the daily buying, where we can see that calls were actually favored on the day comparative to puts. And this would also not be very representative of the market's overall positioning due to the fact that we could see that this really was a low volume day for option trading. Let's go ahead and close product depth, and we'll look at option time and sales. Now, this is called watching the flow. And what you're looking at here is a real-time ledger. If the market was open, this would be rapidly moving as it tracked all transactions that were taken across all strikes and all expirations on the stock Apple. Now, we can see here that lots of these, based on the quantity, are your small retail trades. Even something like 40 contracts isn't really all that significant. What we want to really watch is block trades. Block trades for options typically are several hundred contracts or more traded at once. If you're watching flow for stock, you want to see 10,000 or more shares being traded at once, which is called a block trade. It's because it's more significant because it's typically a position taken by an institution or a very wealthy trader or investor, and usually means there's heavy convictions in the expiration and strike that was chosen, anticipating a big move in the stock. Lots of people see this as very significant because the assumption is that the bigger boys have more information and resources, and they might know something we don't. Now, this one day, we can see that this is today's biggest, right? Two biggest transactions. One day of transactions at this size for Apple isn't really all that significant. We can take a look at these November 15th, 2:30 contracts. If we just open the option chain here at the 240 strike, we can see that this is actually not even the most liquid, right? This would be more significant, let's say, if the volume was greater than the open interest, meaning that a trader is actually betting that the market comes to them and that the liquidity comes to them as well. For a big stock like Apple, that would be highly unusual and definitely something that should be on your radar. But when we look at the time and sales right here, this isn't really significant information in my opinion. Now, if I was looking at this every day and I saw this same strike getting hit over and over for large quantities like this, and then I started to see that it was deviating from the typical amount of open interest and volume that we see on the day, that would make the 240 strike very significant and might make me inclined to believe that the market sees something or is excited about something that I am unaware of. Or maybe I am aware of it and I'm now excited about that because it aligns with something that I've been watching. That's the way that you want to analyze these. Some intraday traders will watch the flow throughout the day, and they'll track things like looking at the delta and looking at the strikes, and they'll look for persistent buying at low delta, high strikes to see if the market's anticipating, a big one-sided move on the day where they can take maybe like a very like a lotto position where they could buy a really cheap contract for 13 cents or $13 rather. In options, you might hear me refer to these as like, this is a $2.25 contract, but obviously we all know that that's $225, right? But these 13-cent contracts, with a 5 delta, if I saw a cluster of buying that kept hitting the tape of people buying at these contracts, it might mean that people are expecting a big one-sided move into the end of the day where the stock just kind of melts up. So if I was trading Apple today, and when Apple was 225, I kept seeing option buyers buy these 222 puts, and it just kept hitting the tape and hitting the tape and hitting the tape. And they were trading at like 50 cents and had a low probability to pay out. That might be significant, and that might be something that I say, okay, I don't have to spend a lot to take a bet on this. And it looks like the market's really targeting this key level, and that might make me more inclined to put a little bet on for that to occur. So that's the way you want to read option time and sales. With the style I trade and what I'm going to go over today, this isn't really something I pay a bunch of attention to, although I do look at option chains overall. And when I'm analyzing a stock, I might start to pay attention to today's biggest trades. The more illiquid the stock is, like if we were looking like at something like KRNT, this is a very illiquid stock. And then we went to today's time and sales. If there was a big bet here on this stock that doesn't get a lot of attention at all, that would be very significant. And as you can see, like I can scroll to the bottom of this. That's how few option positions are being taken on this 3D printing company based in Israel. So in that case, it would be really significant. And I might actually want to pay attention to, there's total 5 options total were traded on this today. This poor stock. But that would be more significant on a small stock like this. And that's when I would want to pay more attention to the time and sales and also the option chains.